Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2 of our sector-specific ETFs guide, we'll cover more examples, share tips for choosing the right ETF, and look at strategies to help you build a focused investment portfolio. Volatility and concentration risk. Sector ETFs can swing hard because they're tied to a single industry's fate. For example, XLE, Energy Select Sector SPDR, spiked during the 2022 oil surge but later fell when fuel prices dropped. When your money sits in just one corner of the market, you feel every tremor. A few red flags to watch. Narrow focus. XLV leans heavily on pharmaceutical and biotech stocks. A failed drug trial or FDA delay could dent the entire fund. Recession sensitivity. XLY includes retail and travel stocks. When consumers cut spending, this ETF often stumbles first. Think of sector ETFs like surfing a single wave. If the wave crashes, you wipe out. Diversification helps soften those blows. Economic and regulatory factors. Government policies and economic shifts can make or break sector ETFs overnight. XLV tanked briefly in 2020 when Medicare for All talks rattled healthcare stocks. XLY slumped in early 2022 as inflation ate into consumer budgets. Here's why external forces matter. Healthcare, XLV, drug pricing reforms or insurance rule changes can shift profits. The sector thrives on innovation but quakes under political pressure. Consumer discretionary, XLY, rising interest rates or job losses can choke off spending. This ETF lives and dies by wallets opening or closing. Even strong sectors aren't bulletproof. If you invest in these ETFs, keep an eye on the news. Headlines move markets faster than earnings reports sometimes. How to evaluate sector-specific ETFs. Picking the right sector ETF isn't just about choosing an industry. It's about digging into performance, costs, and what's actually inside the fund. Whether you're eyeing XLV for healthcare or XLY for consumer discretionary, here's how to vet them like a pro. Analyzing performance metrics. Performance tells you how an ETF behaves in real markets. Look beyond the sticker price and focus on these key metrics. Year-to-date, YTD, returns, shows how the ETF performed this year. For example, XLV might surge during a biotech boom, while XLY could lag if consumers tighten spending. Volatility, standard deviation, measures how wild the price swings are. Tech ETFs often swing harder than utilities. Know what you're signing up for. Dividend yield, important for income seekers. XLV's yield might beat XLY's because healthcare stocks often pay steady dividends. Check these numbers against the sector's history. If XLY's volatility is spiking, ask why. Is it a short-term dip or a sign of deeper consumer weakness? Understanding the underlying holdings. An ETF is only as strong as the stocks it holds. Always peek under the hood. Top holdings. XLV's largest positions, like United Health or Johnson & Johnson, reveal its bias. If one stock dominates, your risk rises with it. Sector breakdown. Even within a sector, there are niches. XLY isn't just Amazon and Tesla, it includes hotels, autos, and retail. Know where your money's going. Concentration risk. If the top holdings make up 50% of the ETF, a few bad earnings reports could hurt you. XLV spreads risk better with 60+ stocks. For a reality check, compare the ETF to its benchmark index. If XLV tracks the Healthcare Select Sector Index, make sure it's not straying far. Quick tip. Look for funds with low expense ratios. Under 0.20% is ideal, and high liquidity, tight bid-ask spreads. XLV and XLY excel here, but smaller ETFs might nickel and dime you with fees or sluggish trading. The goal? Match the ETF's strengths to your strategy. If you want stability, XLV's healthcare giants might suit you. If you're betting on consumer trends, XLY's mix of retail and tech could be the play. Just know what you're buying. Top sector-specific ETFs to consider. If you're looking to zero in on industries with strong momentum, these sector ETFs offer a clear path. From healthcare's steady growth to consumer spending trends, each fund has its own strengths. Here's a closer look at some of the top performers. Healthcare. XLV. The Healthcare Select Sector SPDR Fund, XLV, is a go-to for investors eyeing healthcare. It holds 60-plus stocks across pharmaceuticals, biotech, and managed care, with top positions in United Health, Johnson & Johnson, and Pfizer. Why it stands out? Defensive qualities. Healthcare demand stays steady, even in economic downturns. Exposure to innovation. The fund includes companies like Moderna and Vertex, which focus on cutting-edge treatments. Dividend appeal. Many holdings pay consistent dividends, offering income alongside growth. Over the past decade, XLV has outperformed the broader market during periods of volatility. If you want healthcare exposure without betting on a single drug stock, this ETF does the heavy lifting. Consumer Discretionary, XLY. The Consumer Discretionary Select Sector SPDR Fund, XLY, tracks companies that thrive when consumers open their wallets. Its top holdings include Amazon, Tesla, and Home Depot, blending e-commerce, autos, and retail. What makes XLY compelling? Cyclical growth potential. When the economy strengthens, consumer spending often follows, lifting this ETF. Tech overlap. Amazon and Tesla account for nearly 40% of the fund, tying it to both retail and innovation trends. Rebound play. After slumps, like the 2022 pullback, XLY has historically bounced back sharply. While it's riskier than staples-focused funds, XLY rewards patience. Watch for shifts in employment and inflation. They're key drivers of performance here. Technology. XLY. The Technology Select Sector SPDR Fund, XLY, packs giants like Apple, Microsoft, and Nvidia into one fund. Tech stocks can be volatile, but XLK offers a smoother ride than picking single names. Key advantages. Monopoly-like holdings. Apple and Microsoft make up 40% of the ETF, offering stability amid sector swings. AI and cloud growth. Nvidia and Adobe ride trends like artificial intelligence and digital transformation. Lower fees. With an expense ratio of just 0.10%, XLK keeps costs minimal. XLK isn't just for tech bulls, it's a core holding for many long-term investors. Just know that a market pullback can hit this sector hard. Financials. XLF. The Financial Select Sector SPDR Fund, XLF, covers banks, insurers, and investment firms. Think J.P. Morgan Chase, Berkshire Hathaway, and Visa. Why it fits in portfolios. Interest rate sensitivity. Banks profit when rates rise, making XLF a hedge against inflation. Diversified exposure. Unlike regional bank ETFs, XLF includes payment processors and global giants. Dividend potential. Many financial stocks pay above average yields. Financials can lag during economic uncertainty, but XLF is a solid way to bet on a recovery. Energy. XL. The Energy Select Sector SPDR Fund, XL, leans into oil and gas giants like Exxon Mobil and Chevron. What sets it apart? Commodity-driven returns. Oil prices directly impact XLE's performance. High dividends. Energy stocks often pay robust yields, even when shares stagnate. Inflation hedge. Rising energy costs can fuel short-term rallies. XL is cyclical. Best for those who can handle volatility. Consider it a tactical play rather than a long-term staple. Each of these ETFs gives you a direct line to a specific industry. Whether you're drawn to steady healthcare dividends or tech's sky-high growth potential, they simplify sector investing. Just balance them with broader market exposure to spread risk. Sector-specific ETFs like XLV and XLY let you invest with precision, tapping into industries you believe will grow. You get diversified exposure without handpicking stocks, plus lower costs and flexibility. But remember, concentration cuts both ways. Strong sectors soar, while weak ones drag. If you're drawn to the growth potential of tech or the steady demand of healthcare, these ETFs make it simple. Just weigh the risks, check the underlying holdings, and consider how they fit your overall strategy. Ready to explore further? A financial advisor can help tailor these tools to your goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.